Okay, this is the second part of Learning Unit 2. So just remember, Learning Unit 1 was on your Chapter 1, but Learning Unit 2 is on Chapter 2, and which is covered also in your assignment. And then Learning Unit 3 is actually on Chapter 4, which we'll be covering soon in your lesson. So second part of Learning Unit 2, which is on Chapter 3. So we're looking at production income in the mixed economy. So we're going to be looking at specifically your sources of production, the sources of income, and the sources of spending, and how we put that all together. Okay. So we're saying in an economy, right, these three flows, we call them flows specifically. So please don't confuse the three economic. You have to be able to, especially in the exam, be able to tell me the difference between the three economic questions, the three economic concepts, and this is now the three economic flows or the major flows in the economy. Okay, so we have production, income, and spending. And if you think of it in the context of an economy as a whole, right? We need all three in order for your economy to function. We need production, meaning from production, what are we gaining? We're gaining goods and services. In order for us to actually earn from a business perspective, they need to then sell these goods and services, which become income to the economy, meaning income to you and I as consumers, but also income to the businesses that they can put back. And when we earn income as consumers, we're going to spend. But also from a business perspective, when they get income, they also going to spend it. And in order for them to spend it, they're going to then generate more production. Okay, so this entire cycle happens concurrently in the economy. Okay, there's no break in it. We can't wait for spending to happen in order for production to happen, we're saying this is happening throughout the economy concurrently. If we're looking at a specific industry or specific business, then yes, you can say production is currently happening, and then income happens, and then spending happens. So we have a lot of arguments from consumers, different, not even consumers, but from economists as a whole to say, does production happen first and then income, or does income have to happen first in order for you to be able to produce, in order for us to spend? We can all guarantee, and we've all agreed, that spending happens last. Okay. So we're saying there's three flows, and I'm going to talk through the difference between and what we mean by a flow. Okay, but first we're going to break it up and we're going to say, okay, there needs to be a goods market. So please, please, please do not think of this in a context of a night market or something like that. That's not what we're referring to. A market in economics is a meeting point, and it's a meeting point between consumers and producers. So we have a goods market and we have a factor market. In the goods market, we're saying final goods and services are being traded. Okay. The reason why we say final goods and services, we know, for example's sake, you'll see there it says coffee, right? Is an example of a final good and service. Now, we're not accounting for the coffee that you bought to make this cup of coffee. So the essential coffee beans, if you're going to a very high class coffee shop, plus the sugar, plus the milk, plus all of those things, that is not what we're accounting for. Because if I have to account for the milk that went into making that cup of coffee, the actual coffee beans, the coffee cup, and the coffee itself, meaning the final product, I'm accounting for it twice in the economy. So we don't account for what it took to make that cup of coffee. We're only looking at the final production of that cup of coffee that you have. That's why we say final goods and services, meaning I'm going to consume that cup of coffee. It's a final good. Okay, I'm not going to use that coffee to make another product, i.e., make a coffee cake or something along those lines. Then it's not a final good and service. So me consuming that cup of coffee, final good and services. There we're saying, who are the buyers? It's our households. Obviously, households buy final goods and services. Why? Because we want to consume it. Okay, who are the sellers? The sellers are the firms in the economy. And another way of saying firms is businesses, right? And we're saying real flow, what is really happening in our economy is that firms are selling these goods to households. Okay, but actually what we are saying in economic terms is that households are buying it from the firms. Firms are spending money in order to give us these goods and services. So it's just classifying the difference between now a goods market and a factor market. So the factors market in the economy is where our factors of production is being traded. And our factors of production being our labor, being our land, being our capital, and being entrepreneurship. In the textbook, they also make mention of technology, but we classify technology in entrepreneurship itself, and I'll explain why later on. So, who are the buyers in our factors market? Who are the main buyers there? We're saying it is firms, it is businesses, meaning businesses are trading on land or operating on land. Businesses are buying labor from consumers. I'm selling my labor to the institution, right? But the business is buying it from me. In return for that, I get paid a salary or a wage, depending on the business that you are operating in. And then from capital, what are we gaining from capital, right? We're saying it's buildings, we're saying it's machinery, right? All of those things that help us manufacture these goods and services or make our lives easier in terms of a business perspective, because some of us have more of a service type of business than a production type of business, right? And they're saying, who are the sellers? The sellers are the households. Households are the ones selling their labor to businesses to utilize. So they're saying real flow, what is happening is households are selling their factors of production to firms, and firms are then utilizing those factors of production to generate goods and services. Okay, and for example, I put myself there and I said a lecturer that provides teaching services, and then in return for me providing my teaching services, I get paid a salary, right? I'm part of the factors market. Okay. Then we're saying there's a difference between, and I said to you, the three flows: production, income, and spending. That's a flow, right? And there's two types of classifications. We call some elements stocks, and we call some elements flows. So a stock is something that is measured, or a variable that can be measured at a specific point in time, meaning there is no time dimension, right? And the main one that we use then is we say like your wealth, your assets, your population size, meaning if I had to go research right now what the wealth is of a particular individual. So we're saying Elon Musk, for example, sake, if I had to go Google that right now and I say, what is the value? What is his total wealth right now? I can get a number, right? It's measured at a particular point in time. Same with your assets, right? Most of us have accumulated some assets over our lifetime. Can we go to the bank right now and tell them what is the value of this asset? Yes, we can. Okay. As well as our population size, if we had to go check what is the current population size right now, there will be a number. We will be able to determine what that number is. Therefore, it is a stock. It's measured at a particular point in time. Okay, a flow, which our three economic concepts it's the three major flows, is measured over a period of time. And we usually say that period is a year. Okay, we don't look at things like your income, your profit, and your loss. Or your production for that matter. We don't tend to look at it at a particular point in time. We look at it over a period of time, meaning what is your total income for the year? What is your total profit or loss for the year? We usually look at it over a period of time. And I said, pay very close attention to box 3.1, which is page 61 of the new textbooks, because that gives the examples of stocks and the examples of flows. And that becomes very important. I didn't check now if your assignment has it, but it becomes very important later on in the later chapters, because you must be able to give me examples of both. What is a stock? First of all, what is a stock? meaning it's measured at a particular point in time. It has no time dimension, okay, versus a flow that is measured over a period of time and it has a time dimension. Okay. Then we said we have production, income, and spending. So on the production, we're going to explain what are our sources of production. And there we're saying it's our 4 factors of production, okay? Being the land or natural resources. We either say land or we say natural resources because land is the main resource that we gain, okay? Then we have labor, capital, and entrepreneurship. Okay, this is the main classification also that students have to be able to distinguish between, where we're saying it's primary factors, our primary factors of production being land and our natural resources. Our labor, oh, not land, sorry, our labor and our natural resources. So we're saying our labor is the human element. There is always, here we can see, there's always a human element. Okay, because unfortunately we don't all operate in a system of being, AI that's going to take over everything. We're not there yet. So there is a human, there's still a very big human element in our economy as a whole. And here we're not talking about the quality and the quantity of labor, right? We acknowledge that that exists. Yes, it does exist in our economy, but we're saying labor as a whole needs to be there in order for your government, in order for your business, your economy to function. Okay, the non-human resource then becomes the land. Okay, part of it. Secondary functions we're saying is entrepreneurship and capital. Entrepreneurship is obviously, it's still a human being of some sort because a unfortunately, AI is not part of that, right? So there is a human element still involved with entrepreneurship. And then our capital, which becomes our machinery, our buildings, right? That is the non-human element or the non-human resource. Okay. And then, like I said, we spoke about labor, but I said to you also, we do acknowledge that there is quantity of labor, meaning and quality of labor, but in English, we mean skilled and unskilled laborers. That's what we mean. We acknowledge that that exists in our economy, but we're not focused on that. A business management side of a business would focus on the quality and the quantity of labor. We're just saying labor exists. It needs to exist in order for your economy to function. Okay, in terms of our capital, then we're saying it is all manufactured, meaning man-made resources, our machines, our tools, our buildings, those kind of things would fall under capital for us. So if we're actually looking at it from a perspective of an economy as a whole in our balance statement, so we obviously have a bank, and that is our reserve bank. So in the reserve bank, it's actually called consumption of fixed capital. And that is what's happening globally in our economy, meaning in terms of all of the capital that's being utilized in our economy, right? In terms of our buildings, machinery, tools, all of that. And then obviously entrepreneurship. The entrepreneur is the person that's tying all of our factors of production together, right? Sometimes the entrepreneur is the laborer because he's working alone. Sometimes he employs other laborers, right? In order for him to have a business, he must operate somewhere. That's part of natural resources, whether it's from his house, whether it's from a office complex, or he has a factory, or he has to have some form of natural resource, right? And using capital, then he's trying to minimize his risk. He's trying to maximize his profits. Okay. And then we said technology is the fifth factor of production according to the textbook, but we factor technology into entrepreneurship, meaning an entrepreneur would struggle, any business owner would struggle without some form of technology to make our lives easier. And that's as simple as saying a laptop. A laptop is technology, right? Somebody came up with this laptop. Well, I know I have an HP laptop, right? So I know Bill Gates is making a lot of money at the moment because he came up with this concept of a laptop. I wouldn't have been able to give this service to you if I didn't have a laptop. So there was some innovation involved with when he came up with the design of the laptop, the specs of the laptop, all of those things, there was some innovation and there was some invention involved in trying to make everybody's lives easier, right? And why do we then say that money is not a factor of production? Okay, we say that because money in economics is a medium of exchange, meaning I'm exchanging, I have money, I'm exchanging it for a good or service, I'm purchasing a good or service, or I'm paying debt, I'm settling debt, I'm using it to settle my debt. So it's not a factor of production, it's a medium of exchange. We're using it to either settle our debts, to purchase goods or services. Okay, and then we look at it from a capital intensive, meaning some businesses are capital intensive, meaning they're going to be very heavy on the capital side of it, or some businesses will be labor intensive, meaning they're going to be a lot heavier on the labor side. And in economics or in an economy, we saying certain industries will be capital intensive and certain industries will be labor intensive, but we're saying both need to exist. Okay. Then we get to our sources of income. So we dealt with the sources of production, meaning our factors of production, our FOPs. Now we're saying what happens with our sources of income. And our sources of income is generated from our factors of production, meaning it is our remuneration or our reward for our factors of production, meaning utilizing our factors of production, right? So we're saying for our factors of production, meaning our natural resources or our land, because that's the main one we utilize, we gain rent from that. If I utilize labor, I'm going to gain a wage or a salary. In terms of capital, what do we gain from using capital? Our machinery or even our investments, we gain some form of interest from that. And then our entrepreneurship. An entrepreneur is the reality of it is an entrepreneur is not going to go into business if they're not going to generate some profit of some sort, right? And this is just a summary. So I've given you sort of outlines from the textbook on each of the factors of production, right? So you can go through that through the semester. And then our sources of spending. So we're saying, right, who spends in our economy? Who are the main spenders in our economy, right? So we're saying there are four spenders in our economy. It's households, it's firms, or another way to say households is consumers. Another way to say firms is businesses, our government, obviously, okay? And then we're saying our foreign sector, okay? And where we get the foreign sector from, we're saying if our economy operates alone, meaning in isolation, we are not interacting with any other economy or any other country, then we're seen as a closed economy. But if we are interacting, which South Africa does quite a lot, with other countries, we have a foreign sector. There is some form of import and export that is happening within our country. Okay, so we're saying, like I said, households. Another way of saying households is consumers, and consumers then spend. So it's a group of individuals who live together. That's a household, right? Who make joint economic decisions. Okay, and from that joint economic decisions, we're deciding on what goods and services are we going to purchase in our household. You've made that decision every month for your household. Other households make different decisions, right? And then from a firm's perspective, we're saying firms are then utilizing our factors of production to generate some form of investment or generate some form of profit or generate a good or service that they would end up selling back to consumers. Okay. We then also acknowledge the fact that there are different types of firms, meaning your sole proprietors, your partnerships, your companies, private or public, and then our CCs. But that's not the main aspect that we're looking at here. We just acknowledge that it exists. So this is more of a business management concept where we're saying, yes, these are different types of firms, but you'll never be asked in economics to please give us the advantages and disadvantages of these different types of firms. Okay. And then our government. So we're saying our government over and above that, they govern the laws. They give us our laws in society, right? They try and protect us. They also have some spending that they have to utilize, meaning they have to gain income. And where do they gain that income from? We're saying they gain their income from our taxes. And in return for that, we giving of our taxes every month. In return, what are they giving us? They're giving us goods and services, meaning public goods and services, right? So they're saying our public roads that we utilize every day. So they're supposed to give us these public goods and services in return for our taxes. And then also the transfer of income and expenditure from certain individuals, meaning wealthy individuals, to the poorer individuals. And by referring to that, we're saying a lot of our social grants would fall into this kind of category, where we're saying we seen as the wealthy, because we can afford to pay taxes. Whether we can or can't afford, that's debatable. But we ultimately, according to the government, based on how much we earn a month, we pay a certain amount of taxes. Businesses also pay certain taxes. We also pay taxes on VAT. VAT is a tax, a form of a tax. We pay our carbon taxes. We pay for the road accident. These are all taxes that get executed to South African citizens. So we are one of the most overtaxed countries in the world, on top of our sin taxes. And that's just for luxury and pleasure that we have these sin taxes every month. But the government still utilizes that as income. And then in return for that, we are expected to get our goods and services, our public goods and services. Okay. And then from our foreign sector, there we're saying it's our exports and our imports. So what are we exporting to other countries versus how much are we importing? Now, in an ideal situation, we do want our exports to exceed our imports, right? But unfortunately, in South Africa, because we don't manufacture a lot of the machinery, a lot of our goods, our products that we use on a daily basis, we don't manufacture that locally. We import it because it's cheaper. And China being one of our main countries that we trade with for goods and services. And our exports, what we export a lot of is food, but because we still need food in South Africa on its own. We can only export so much of our food. We don't export a lot of other goods or services. Food is the main thing that we export to other countries. And then ultimately, this then determines our total spending in the economy. So another word for saying total in economics, you'll see, is aggregate. Okay, so aggregate and total mean the same thing. And then spending and expenditure also mean the same thing. So we're saying when we calculate the total spending in our economy based on all of the sources, meaning our households, our firms, our government, our foreign sector, our imports and our exports, ultimately what we are saying is we want to calculate the GDP of our economy. And our GDP is as simple as our C plus our I plus our G plus brackets X minus our Z. And we're saying the C is consumption from households, consumption spending from households, consumer spending by households. Then we have our investment by firms, our government spending, our exports, and then our imports. And this ultimately determines our GDP for our country, meaning our being the gross domestic product that measures the monetary value of all final goods and services bought by us during a certain period of time. And we always say that has to be within a period of a year within the borders of our country, right? And then we're saying, okay, let's now look at it from a context of how do we put this all together? So we acknowledge that there are households, we acknowledge that there are firms that exist. And then we said there's a goods market and a factors market. So remember that we as consumers operate a lot more in the goods market. So that is why this arrow of where. So households are spending in the goods market, meaning we are buying these final goods and services in the goods market. The goods market is then utilizing all of our spending, and that becomes income to the firms because the firms are selling these products to us, right? And they gaining interest, not interest, sorry, they're gaining income in return for selling these goods and services. They then spend in the factors market, meaning they are gaining factors of production that they then utilize, and that because households are selling labor, we're selling factors of production, we gain it back as income. So we're gaining wages, we're gaining profit, right? And then the cycle is consistently happening the whole time, right? So how the arrows are formulated, meaning from households to the goods market, we are spending. From the goods market, it becomes income to the firms. Firms then use that as spending back into the factors market. The remuneration for our factors market then becomes the income that generates back to households. Okay, those arrows are very important. Okay, this is also the opposite way where we're saying, what are we gaining? So we said firms are selling goods and services in the goods market. That's goods and services is also what households utilize on a daily basis. We're utilizing these goods and services. Yes, we are spending in the goods market to gain these goods and services. And then from there, what are we selling? We're selling our factors of production in the factors market. And then the firms then utilize these factors of production that then they use to generate goods and services. Okay, so it's almost a vicious cycle continuously happening between the goods market and the factors market and between households and our firms. And then there's a short video that you can listen to that will help you explain everything as well. And then we said, okay, what then happens in terms of the government? So where does the government then factor in all of this? So we're saying the government is kind of in the middle between our households and our firms. So households give taxes. So there, this line, okay? Households give taxes. Oh, I'm trying. Yeah. Households give taxes, okay, to the government. Firms also, businesses also pay company taxes, right, to the government. In return, the government gives us public goods and services. So they give it to households and they give it to firms, right, that we then utilize on a daily basis. As part of that, households are also spending. We also have consumer spending that is happening, right? So we are spending on final goods and services. But firms are also spending on final goods and services, right? So that is also happening right there. In return for the firms selling these goods and services in the goods market, which households then are spending to gain these goods and services, there is income that gets generated back to the firms. Okay. And then from the factors market, we're saying the government also gains factors of production. They're also gaining labor, meaning there are laborers that work for the government. Our president, he's a laborer. He works for the government. Okay, he's also being paid a salary every month. Okay, and in return for that, we get government spending in the factors market as well, right? Because if that didn't exist, meaning our natural resources are not there, our land is not there. Remember, the government owns land. They're also the biggest owner of labor in our specific economy. In return for that, we gain income. So that's our remuneration for our factors of production. And then spending also happens in the factors market by firms. And in return, the firms are utilizing all of our capital, our labor, in order to generate these goods and services. So this is kind of what's happening in the economy on a daily basis. We're just saying there has to be a give and a take. So in economics, there's always a give and a take. And we want to look at what are we giving versus what are we taking. So the government takes our taxes. What are they giving us? Public goods and services. Okay. As consumers, I'm saying, what am I gaining? I'm gaining goods and services from the goods market, and I'm spending also in the goods market. Okay. From firms' perspective, they also want to say, what are they gaining? They're gaining factors of production. And in return for those factors of production, they want to gain remuneration for those factors of production and ultimately generate goods and services. Okay, so there is constantly this give and take. And we refer to that in a context of what is a leakage into the economy versus what is an um, injection into our economy. So an injection is what is being added back into our economy versus what is being taken out of our economy. So we're saying our taxes is what's been taken out of the economy, right? We don't have a say in how that money gets spent. We don't have a say in how much of it gets spent. It just gets taken out of our salaries every month. Okay. Firms have to pay company taxes. They don't have a say in that because they operate in South Africa. They have to pay taxes to the government. We don't have a say. So that's a leakage out of the system. And then in return, what is the government supposed to give us? What is the injection back into the economy? We're saying public goods and services is what they're supposed to be spending our money on. So that's the injection back into the economy. Okay. So there's always this give and take. So consumer spending is the injection back into the economy. We're saying consumers have to spend all of their income. What gets removed out of what is the leakage from a consumer perspective? We're saying savings. Savings to consumers in economic terms is the leakage out of the system, meaning we are not able to spend that money because it's lying in your bank accounts, because it's lying, in your mattress underneath your bed because you don't trust the banks. That's the leakage out. The injection back in is consumer spending. From a firm's perspective, in terms of investment, they also have savings as their leakage, and their injection is investment spending. They're investing back into the economy. Therefore, it's an injection into the economy. Okay. And then from your is your leakage versus, okay, we're saying that your leakage out of the system is your imports, your injection is your exports, meaning when we are importing all of our goods and services that we do, and I usually use Adidas as an example because I'm a fan of Adidas footwear, then I'm saying I am purchasing this Adidas sneaker, but I know that the sneaker itself is not manufactured, it's not designed in South Africa. Nothing about it is a South African product. So I'm paying, yes, I'm paying 1,500 Rand or 2,000 Rand for an Adidas sneaker, but I'm paying the American equivalent in South African Rand value, if that makes sense. Meaning when I purchase that sneaker, the funds it leave the country, they then convert it. So if it's an American company, it will get converted in the American economy into dollars, and then I get the sneaker in return. So the money has left our country versus exports. That's an injection into our economy, meaning we are selling goods, we're selling our agriculture to other countries, and they have to pay us from their currency to our currency. That's why it's an injection back into the economy. So remember, there's always give and take. Okay. This is also what we spoke about in terms of the financial sector, meaning what is the leakage, what is the injection? So the injection from a financial sector is the investment spending by firms, and then the leakage out, the savings from households perspective. Again, we also saving. So there is a financial sector, and if we don't have a very good financial sector, our entire economy will collapse. And there we're saying our financial sector is essentially our banks, right? They are part of our financial sector. Our insurance sector, they also part of the financial sector. Our pension fund, our stock exchange, they all form part of the financial sector in the economy. So they're basically saying there's borrowers and there's savers in our economy, right? Our borrowers are deficit, we say are deficit units, meaning people, individuals, businesses are borrowing money from savers, meaning our savers, if you have money in your account every month, the bank is essentially borrowing out that money to people that are applying for loans. So yes, you have that money in your account 100%, but in economic terms, that money is actually floating around somewhere being borrowed to somebody else. And in return for borrowing out the money, the banks gain interest, and that interest is what's paying when you want your money back. Okay, and that's how the economy is constantly running on a daily basis, right? So you must be able to tell me, what is the leakage? What is the injection? Is it coming? Is it going? Is it coming from the factors market? Is it going to the factors market? Is it coming from the goods market? Is it going to the goods market? Right? And then this one picture just summarizes everything. Right? So we added in the factors market, the financial sector, sorry. We've added in the government sector. So what is the injection back in? Is government spending? What is the leakage out of? That is the taxes that the government gains from us, with the main sources of income here being the households and the firms. Households are saving money, that's the leakage out. We are also then, so this white line is our consumer spending, right? That needs to happen. And then in return, firms also gain investment spending, that's the leakage back into the economy versus the savings that is the leakage out. So the investment spending is the injection in, the savings is then the leakage out. And then in terms of our imports is our Z, our imports is a leakage out of the system versus our exports, that is the injection back into the system. So you must be able to tell me what is coming in and what is going out of the economy as a whole. All right. And that's a very short, very quick video on the second part of Learning Unit 2.